So thanks so much, Tony, for having the paper. Let's see. Share. All right, so we've got this lovely title. The paper's with Sam, who's here, and then Abby Sussman, who's at the booth as well. And so here's the idea. Here's what we're going after. So this is a a seminar we've all sat through like 1,000 times. Someone walks in and they're like, "Hey, X, pick your favorite thing, is a price risk factor." Right? And so what they actually mean by this is the following. Right? When they say this, they're saying something like, I think there's a bunch of people in the economy who are sitting there and looking ahead and going, shit, I'm really worried about not having money when this variable X drops. Right? And so what I'm willing to do is pay more for stocks or any asset that has high returns in those bad states of the world. Right? They really want to go and insure those bad states. And as a result, right, those assets that provide lots of insurance are going to have higher prices and lower expected returns going forward. Right? That's the plan. And so the way we go and we test this is we look at purely econometric analysis on market data. Right? So the idea is that, well, if that's going on, right, we can go and look at you're seeing a plot of cumulative values of X, whatever that is, and some particular stock's cumulative returns. Right? And it better be the case that if you go and you look at stocks that have a relatively low correlation, right, with X, these are going to have higher prices and lower expected returns. And if we were to go and compare that to a stock with a higher correlation with X, it's going to have a lower price and then even higher expected returns, right? And so there should be a nice relationship between correlations and expected returns in data. It's totally consistent with the theory, right? But it's also true that there's lots of other stuff that could explain this correlation, not just the sort of model you have in mind. And so our key idea in this paper is that, look, if this is what you're saying, right, you're making a claim about what investors are trying to do, right? You're making a core claim about investors' logic. Right? This is a testable claim, right? And the right way to do this, the right way to go about testing it, is to go and use surveys. Right? So the whole idea in this paper is that let's go and test our standard asset pricing models, right? By going and looking at the core claim they're making about investors' economic reasoning. We're going to do it using a survey experiment, right? And the idea is that you could go and plug and play with this exact same survey experiment with any sort of risk factor you have in mind. And so this will apply anywhere, but in order to sort of test it, in order to sort of demonstrate how it works, right, we're going to go and use consumption growth. Right? And so we're going to go and survey a bunch of different kinds of investor types, sort of lay people, MTurkers, a group of finance professionals, MBA students, a bunch of wealthy asset managers at an investor conference. And so we're going to find a couple key results about consumption growth. So first, right, when we run our survey experiment, we're going to find that they don't adjust their sort of demand at all in response to this correlation that all of our standard theory says is key to their investment decision. Right? What's more, right, most people aren't even thinking about it, and those that are thinking about it the wrong way. Right? They're trying to buy more stocks, right, whenever it's more correlated with consumption growth. Right? And then we're going to go through and we're going to back up these results with a bunch of field data. And so the key takeaway, right, the goal is not to have you guys sort of think we're sort of piling on the cap band, C cap band, right? The whole point here is not to sort of say this is a bad model, right? Our bigger picture point here is that we should care about why it doesn't fit the data, right? It's one thing to say that a model doesn't fit the data, econometrically. It's another thing to wonder why, right? Suppose we had found opposite results, right? We had found that, people were kind of responding to sort of changes in consumption growth correlations, but not sort of as strongly as you expect, right? They were thinking about it the right way, and they just weren't really reacting as much. Well, this would suggest that we should add other things to the standard, consumption-based model, right? And that's the way that the entire sort of profession has gone so far. But if people aren't paying attention to this at all, and if they are, they're thinking about it the wrong way, this suggests that adding bells and whistles to this sort of standard theory is not the way to proceed. Right? What we're not trying to say is that no one's caring about risk or return, right? This is clearly not true, right? There are certain situations where people are even caring about risk factors. Right? You think about oil prices, right? They're clearly driven by people, different companies trying to hedge their oil risk exposure. Right? In our data, we're going to show you evidence that people are thinking about risk and return. They're just not thinking about it as consumption growth correlations. Right? Our big picture point is that we should be asking these sorts of questions. Right? A key part of all of our theories is a statement about what investors are doing, right? What they're trying to hedge, right? And this is a testable thing, right? And you can use our framework to go and test this going forward. Right? So Here's how this is going to sort of play out, right? I want to spend a couple minutes talking about who our participants are, right? Who's answering these questions. And then the bulk of the sort of talk, we'll be talking about the actual survey experiment, where these guys are answering sort of investment decision questions and answering questions about their economic reasoning. We'll talk about some supporting sort of field data, right? If you go and you look at the Wall Street Journal, right, all of this makes complete sense. To talk about some common concerns and things like this in the discussion, and then at the end of the day, we're making an ask for how people are evaluating risk factors going forward. Right, when you're sitting in this talk again, right, when you're sitting in another one of these talks where someone proposes a new risk factor, we're asking you to sort of change how you're evaluating that evidence. Right, and I'll be clear about exactly what we're doing there in that last part. So here's who's taken our survey. So we got four big types of investors. Right, so we're going to be asking a bunch of sort of M-Turkers, but we're also asking a bunch of finance professionals. Right, these are people who are then collected by a company that solicits particular groups for surveys. And some of these guys are going to be professional traders, right? So it's not just your bank teller or the custodian at your local bank, right? These are people who are actually trading sort of stocks or bonds for a living. So we got roughly 500 of these guys. We got 300 something M-Turkers. All of these two groups, they took the survey online, and in order to actually be included in our sort of data, right, they had to pass a 5-question comprehension test. Right, they all sort of understood what average growth was in the economy. They understood what volatility, correlation. They answered all these questions correctly on the first try. The other two groups of people we're looking at are MBA students, right, and then a group of asset managers, right. So the MBA students are just booth MBA students, right. They took a pen and paper rather than an online version of this in a break between class. Got 300 of these guys. We also have this group of asset managers. These are investors who are attending a conference for a huge asset manager. And as part of the sort of as part of the conditions of being able to give them the survey, right? We can't say who the person was, but you should think of these people as deep pocket investors. These guys took the survey on a tablet, like at a booth at this conference, and because we are sort of just assuming that they're deep pocket investors, we didn't sort of ask them a bunch of background questions about who they are. So here's who we're giving our survey to, right? And so here's what the actual survey looks like. So first thing we're doing is asking them, each person takes a survey, a bunch of investment questions, right? So they're going to look like this. Right, so we're basically saying, look, you got $1,000. You can invest it between this mutual fund, right, and a bond that's going to earn 2%. Right? We're giving them a bunch of information about the particular mutual fund, right? So here you're seeing it's earning a 4% rate. It's got a volatility of 20%. Got this correlation between economic growth. Is what we're calling sort of consumption growth here, and this mutual fund is 0.15, right? And so we're giving them all the numeric information. And then we're also showing them a time series, right? That blue line is the cumulative sort of growth in GDP, right? That's going to be the same, right? This if someone sees this question multiple times, that's going to be the same in every one of the questions. This stock market time series is that green line. This is the cumulative returns, and this will change from question to question, right? So the finance professionals and sort of M-Turkers saw 10 of these questions. So this might be the first one. They'll go through the answer. I'm going to put $600 of my money in the mutual fund and $400 in the bond, right? And then they'll see another question. Right? The blue line is going to be the same, right? Green line changes. The parameters are different. They see new parameters. They answer another one of these. They say, oh, now I want to do 300 and 700. Right? They see another one of these. Right? So the finance professionals and the M-Turkers saw 10. Right? The MBA students saw 6, and the asset managers saw 4 of these for time constraints. Right? So we keep on going through. Right? Every one of the questions had the same sort of economic growth time series. It's actual data. Right? What we're then doing is simulating, right, that green line that they saw, the actual stock returns, using parameters that were randomly drawn from this set of values. Right? So we pick a single sort of mean returns for the stock market. We pick a single volatility, and we pick a single correlation with economic growth. Right? This is a big range for these economic growth. Right? It takes you could sort of explain much of the equity premium puzzle by choosing having a change in measurement error of 0.16, right? So we're choosing a range of values that's 3 times that big. Right? And so we're going to use the following 3 variables to sort of indicate what the particular value of that parameter was, right, in the particular question that a subject saw. Right? So in the first question, right, if the data was simulated using a mean return of 4%, that mean IQ would be 4%. Right, so it's a particular value, and we're running regressions that look like this. Right, so left-hand side variable is what fraction of that $1,000 right, did the subject invest in the stock market, right? So if they put $700 in the stock market and $300 in the bond, that would be 0.7. Right? And so we're gonna run a bunch of regressions that look at like something like this. Okay, so each column here is going to be a different regression, right? We're pooling everybody together right now, all different, 4 subject types, right? And I want to walk through sort of what our main set of results are. Right? So first thing we do is run a regression that just has that mean return on the right-hand side. Right? So standard theory says, look, people like having things with higher means. You should have a positive coefficient, and that's actually what we see. Basically saying that a 1% increase in the mean return of the stock market has a 3.24% increase in the fraction they invest in stocks. Right? Average stock fraction is about 60%. Right? So if you went from the lowest regime to the highest regime, right, it'd be about a 20% change in their sort of investment. Right? Look at 10,000 observations. These are stock by individual observations. Right? So every person in the sort of M-Turker sample contributes 10 observations to that number. Right? And it's a huge T-set. Right? People clearly care about the means. Right? For volatilities, we expect a negative coefficient. Right? The more volatile the stock market is, the less people are going to invest there. And again, we see a negative coefficient. Slightly smaller magnitude, but again, huge T-set. Right? We're basically seeing here as I move from the lowest regime to the highest regime, you'd have about a 10% drop in people's investment in the stock market. Okay, correlation should also be negative. Right? If stock market is more correlated with this key sort of macro risk factor, right, it's a worse hedge, and so people will be willing to pay less for it. Right? We find a precisely estimated zero. Right? These are T-stats clustered by participant. Before we were looking at mean volatilities, they were north of 10, and we're getting a 0.00 out to 2 decimal places. Doesn't matter if we throw them all in together because we're randomizing which parameter values each participant saw in every question. Right? So these are our main set of results. We can clearly find evidence that people care about means and volatilities. They care about risk and expected return. Right? It's just not a risk that's captured by this sort of classic sort of canonical sort of risk factor that we build all our models on. Right? So obvious follow-up questions, right? Well, maybe it's driven by sort of participant heterogeneity. Right? Okay, well, let's go and run our same sort of regression, including correlation on the right-hand side, and split it up by these different groups of participants. Right? You might, maybe it's the sort of financially unsophisticated guys that are sort of like masking the real results. Right? Well, if that's true, then we should find different results for the financial professionals and asset managers than the M-Turkers. Right? Nope. Right? If anything, the only remotely safe coefficient we see is MBA students, and it's the wrong direction. Right? It's not driven by other participant characteristics we can observe. Right? So what you're seeing is this, the coefficients on the mean, the volatility, and the correlation, right, in each one of these rows, right, and each column is a separate regression, right, where we're restricting to, so on the left, it's people below the age of 40 and people above the age of 40, right, or people who are male and people who are female, people who have low income, high income, and so on, right. Anything that's sort of solid, sort of colored, either blue for positive or red for negative, is significant. Insignificant stuff is sort of a shadow rather than opaque, right? But you're basically seeing the same pattern across all these groups. Right? Another thing you might be worried about here is that it's the particular labeling, right, of that risk factor that's sort of driving all of our results. We're calling it economic growth. Maybe if we called it personal income, right, or sort of wealth, something like house prices, industrial production for pick your favorite thing. Right? Well, we can do exactly that. Rerun our experiment, right, and see what people respond to. Right? If it was about the relabeling, it should be the case that you now all of a sudden see a negative and statistically significant coefficient for one of these effects. Right? When we do this, it's the same results all the way through. Right? I want to be clear, labeling does matter. You're seeing variation in the mean and volatility coefficients. Right? If you relabel stuff, people can like some things more than others. There's totally reactions here. There's no reaction to the correlation coefficient though. Right? Here's another thing you might be worried about. Maybe it's something about the way we're displaying the information, right? Everyone passes comprehension tests, but maybe there's something weird about what's going on here. So what we could do is go and sort of manipulate the actual parameters of what we're showing people and see what happens, right? So one thing you might be worried about is maybe people don't get the exact numerical values of the correlation. Okay, let's go through and just label them instead of 0, 0.15, 0.3, and 0.45. Let's label them none, low, medium, and high. Or let's go and give the people extra instructions saying the correlation is between -1 and 1. Right? We do either of those things, right? Nothing happens. Right? It's not about numeracy. It's a general effect where people aren't paying attention to that one particular parameter. Right? The cumulative returns and sort of cumulative consumption plots we're showing people that are time series. It's not the most obvious way to show correlations. right? So one thing you might think about doing, all right, let's go make this really obvious. Let's go show people scatter plots, right? What that's going to do, right? If we sort of think this through ahead of time, it's going to make it harder to see the mean sort of growth rates, right? But it's going to make it much easier to see the correlations between the two variables, right? So if it's what's really going on is people are sort of confused by this plot, you should see the mean effect drop, right? But you should see the correlation coefficient now all of a sudden become negative. When we actually do that, we see the mean effect drop, right? The correlation effect is positive now. When we highlight the correlation, people do more of the opposite thing. Right? We could think about doing the same thing now. Instead of just showing a scatter plot, let's show just no graph at all. Just show them the numbers. Right? Just to focus on the exact things we say here you should care about. Right? If that happens, we should expect both the sort of mean and volatility effects to sort of shrink because these aren't being sort of highlighted by a graph. Right? But we should at least expect people to sort of pay attention to the correlation. Well, we see both the mean and volatility effect shrink. But again, the people now that are sort of really focusing on that correlation, it's the wrong way. Right? If anything, right, when we really highlight the correlation effect, people are thinking about it and acting it the wrong way. Right? I'll come back to this in a second, right? So say a couple more things about this, right? So we've shown you a few different tests, right? But I think for some of you, your reaction right now is, all right, so I get this, but what if you ran it the following way, right? With some X tilde instead of like the, consumption growth. We did, so instead of industrial production, maybe you're worried about, some variant on that. One of the cool things about surveys is we can totally do that. Right? We want to run a bunch of variants, right? At this point, we run enough of them, we'd be surprised if our results totally flip, but let's run more. Let's talk afterwards. Right? What we're trying to do here is change the standard of evidence people use to go and evaluate these sorts of models. Right? And so, what we want is everyone to sort of be doing this sort of thing going forward. So let's talk afterwards. We can sort of run more new things. But one thing that's sort of like we're sort of thinking through is exactly what would it mean at this point, right? If we found that for some particular variant where we label consumption growth in some weird way, all of a sudden people behaved or responded to it exactly like we thought it should. Right? Notice that because they were, because the original way we were labeling consumption growth and this new thing, right? You've chosen them such that they're sort of empirically look really similar. Right? Our existing models and sort of empirical approaches just colorblind this distinction, which would mean that if we found that only one of them worked, right, we would need some extra new tool, new framework for thinking about why, and in order to actually test out the distinction. Right? Finding that one particular way of framing the problem all of a sudden works would actually be evidence that we need a new approach, right? Not the vindication of what we're doing already. Okay, so we go through, we start with this sort of, main line of our sort of survey experiment where we sort of ask people to solve this portfolio allocation problem, right? And what we then do is go and follow up and say, look, you went and you answered these 10 questions, right? What were you thinking? Right? How are you going about doing what you're doing? Right? And so we're doing this using a two-stage approach because we don't want to sort of we want to sort of mitigate the effects of experimental. Right? So we start by asking them a question, which is, all right, when you were going and making your choice, what were you considering? Right? Average growth, uncertainty in the market, sort of relationship between the two things, other. And then suppose they said average growth. We then go and ask, all right, so when you were thinking about this, were you trying to buy more stock when the growth was higher or lower? Right, so this is always this two-stage approach, right? Right, and the experimental demand effect might cause you to sort of respond by sort of answering or thinking about things, right? But it's not going to tell you which direction you should be responding. Okay, so what I'm showing you now is this table is going to be the results of these questions, right? And so each column is going to be answers for a different parameter, right? And each row is going to be a different kind of answer. So was the person thinking about that question at all, right? What's that person thinking about in the textbook direction? Right, so for mean returns, it's going to be buying more stocks when that was higher. For volatility, it's buying less stocks when it was higher. In correlation, it should be buying less stocks when that correlation is higher. Right, and then bottom row is going to be conditional on thinking at all. What were you? Which direction were you trying to go? So, just in general, right, people are thinking less about the correlation parameter to begin with. Right, this core parameter that's sort of like the heart of all of our sort of asset pricing models. 57% of people just said they weren't even considering. If you look at the mean and volatilities, right, some people weren't thinking about them, but those that were doing it in the way we would expect from textbook theory. Right? And that's what you're seeing in that bottom row. 3/4 of the people who were thinking about either the mean or volatility were thinking about it in the direction you expect. And those pluses are telling you that 76 and 72% is statistically different from 0.5. Right? It's greater than 0.5. If you look at correlations, though, right, 3 out of 4 people who said they were thinking about correlations were doing it in the opposite way, right, than textbook logic suggests. Right? Only 11% of people were thinking about correlation in the textbook direction, right? Right, and those people, right, only represented 24% of all the people who were thinking about it at all. Right? We put it a different way: 3/4 of the people were thinking about the correlation between stock returns and consumption growth, were trying to buy more stock, right, when that correlation was higher, and those stocks were a worse hedge against consumption growth shocks. Okay. One of the great things about running this, like the survey, the way it's set up right now, is that we can provide converging evidence on what people are doing, right? So we can go and take that second part of our survey and go and compare it back to that first part. Right? So here's what I'm showing you here, right? So this table, each cell is going to be the results of a separate regression. Right? And so each column now is going to do the following, right? We're going to run that stock fraction on the different right-hand side variables for the value used in that particular question. Right? And we're just going to look in that first column at the people who said they weren't thinking about that parameter at all. Right? So, first of all, people who weren't thinking on mean volatility correlation. Second column is going to be the people who said they were thinking about it. Third column is going to be the people who said that they were thinking about the parameter, but were doing it the opposite of textbook direction. Right? And fourth column is people who are thinking about it and thinking about it in the textbook direction. Okay, so the benchmark coefficient for means was a 3.24% increase for a 1% increase in the actual value. Right? When we compare people who weren't thinking about means, people who were, but even people who weren't thinking about means were still increasing their demand when the mean increased, right, by 2% per percent. Right? So they were still doing more when they said they were thinking about it. When we look at among people who said they were thinking about that parameter, they were really strongly and aggressively going in that direction, right, when they were thinking about it in the textbook direction. Same thing when we look at volatilities, right? The original coefficient was 0.61, it was negative 0.61. Right? Even people who said they weren't worrying about volatilities actually were still trading in that direction. Right? They were just trading more strongly when they said they were worried about it, right? And people who said that they were thinking about textbook direction were actually trading that way. We got a 0 coefficient for correlations, right? But when we go and look at the distinction between what people said they were doing and what they were actually doing, right? There was basically no difference at all between their demand when they said they were thinking about parameter at all or not. And if we look among people who were actually thinking about it, you can already see a positive coefficient there, which is the wrong direction, right? And there's no distinction at all between their demand conditional upon following textbook logic or not. Right? So the 11% of people who said they were thinking about this in the right direction is likely just noise. Right? No survey is going to be perfect. We're going to have some sort of like sampling variation. This is all signs point to like this just being the fluke of our just any empirical work. Right? Okay, so we've run the survey experiment. We asked people to solve this portfolio allocation problem. Right? They do so. They really respond to mean changes. They respond to volatility changes. They care about risk and return. They respond not at all to changes in consumption growth correlations. Right? So there's just an expect that doesn't. So there's no evidence that people are actually thinking about sort of risk using this standard sort of parameter that shows up in all our models, right? But in some sense, it's not it's kind of surprising we had to go through all this effort with the actual survey experiment in the first place. If you were an alien coming down to Earth, right? You had read all of our finance sort of academic papers, right? You follow that logic. You sort of thought about what would be important, right? Oh, consumption growth correlation, maybe sort of other kinds of sort of risk factor correlations, right? If you then read the Wall Street Journal or looked at any sort of financial news, it would be kind of shocking, right? You open up the Wall Street Journal, they talk about lots of stuff, right? There isn't like a giant risk factor correlation section like sort of showing there up there at the top. Right? Consumption growth correlations, aggregate risk factor correlations don't show up in Bloomberg, your standard sort of risk assessment tools, right? This is just not something that people talk about at all, right? And so this should give us pause just to be very, it'd be a weird thing to start all of our models with as the first and foremost thing when it's not the first and foremost thing that anybody talks about. But we can actually do a little better here. We can actually go and systematically look through and see, well, can we find a place where people would have to be talking about this, right? And just check whether or not they are, right? And well, let's go and look at mutual fund prospectuses, right? A mutual fund has to go and sort of, announce all of its risk and investment objectives, even if everyone already knows about them, right? For legal reasons. So, even if everyone sort of already knows that the stock market might go up or down, mutual fund prospectuses mention this as a risk because they're legally obligated to, right? And they'll go through really detailed calculations, right? They'll go through entire examples about how sort of turnover and sort of taxes and all sorts of costs, right? They matter. Like these are not like documents that shy away from sort of boring details. Right? So if it was the case that these guys were all worried about the risk factor correlation, this is the place to see them. So we go through and we look at the largest 25 U.S. mutual funds, right, and ask, right, how many times did they actually just mention a correlation or covariance at all? Right? 8 times split across all 25, they show up in 3 of those mutual fund complexes. Right? None of them mentioned a correlation or sort of risk factor in any of this in their investment risk or objectives. Right? And none of them reported any of the sort of information that you would need to go and compute this on your own. All of the mentions, they had nothing to do with actual sort of risk factor correlation. They had to do with like tracking error, right? Or derivatives that were based off of, like, that were part of the portfolio. But they're not talking about this in a way where it would sort of correspond to our standard asset pricing theory. They're talking about it in a way that's sort of an offhanded comment about something that was sort of tangentially related to the portfolio. Right, so this sort of like, suggests that, there's not a whole lot of evidence from just the field suggesting that people are actually trying to follow the logic that is at the heart of all of our standard sort of, asset pricing theory. Right, thanks, Tony. Okay, so let's talk about some important details about what we've done so far. So first thing is we're trying to go and test this necessary condition. Right, the key thing I want you to take away from this is that, well, all of our models, the way our standard asset pricing models work is that prices are moving today because people are trying to go and insure themselves about a specific bad future state of the world. Right, this is the logic. Right? If that's actually what's going on, right, then it shouldn't be that hard to go and find someone who is afraid of that state and trying to insure themselves. Right, this has to be going on in order for this to actually be the explanation for why prices are moving. Right? We totally get, right, that prices can move for reasons that are more complicated than people currently understand. Totally makes sense. Right? The interesting thing about these theories is that they are making a direct claim that prices are moving precisely because of something that people do understand, right? An asset's exposure. Right? The idea behind the way we set up these models is that the stock market and all these markets are insurance markets, right? And so we should try to explain them by sort of extending these same principles. Right? It's totally possible for an asset to provide insurance even if people aren't aware of it. But the price of that asset cannot contain an insurance premium, right, unless people are aware of its insurance value ahead of time. Right? The only way for its price to move today, because people know about its insurance value, is they have to know about the value. Right? People generally know why they're paying higher car insurance premiums. They generally know what they're paying for, right, when they're buying fire insurance on a house. Right? If we're going to apply these, extend these same principles, well, then let's go and test whether or not people understand what they're what they're paying for when they're bidding up the prices of certain stocks or bonds. One thing I would experiment or demand effect, we were talking about this a little bit, right? If anything, right, the way this experiment up is it should make it more likely that people respond to correlations. We're showing them 5 numbers. There's no extraneous information. We've run versions of this where they're literally only seeing the 5 numbers. Like there's no graph, they respond to 4 of them. Right, the one that says is supposed to be at the heart of our theory, right, like a relevant number, is the only one they don't react to. We're not giving people high, very strong monetary incentives. Right? We're not paying them for getting the right answer, right? Right, and so you might be worried about that. But if you are, right, well, here's the thing: everyone responds, right, to changes in means of volatility exactly like you expect. Right, it's only this one parameter that I'm reacting to. Right, so this isn't a situation where all of our results are sort of, you can be discounted. They can be discounted because we're not sort of giving people thousands of dollars for getting the right answer. One thing that always comes up with like survey experiments is like, well, shit, are you asking the right people, right? This is a really big problem, right? Especially if you're trying to estimate a particular parameter value, right? If we're trying to estimate risk aversion out to 4 decimal places, it really matters whether we've got the marginal investor, right? We're not trying to do that, right? What we're trying to figure out is, do people react at all, right? We've got a really broad swath of investors, including really deep pocket investors at like a conference of a sort of massive sort of fund manager. We've got professional investors, some of them are traders, right? We're missing people, right? But if we're not asking the right people, right, there's no reason why we should expect, there's no good theory for why all the people we are asking have a precise 0 response, right? If we're asking the wrong people, then we have to incorporate who is the right person to ask, like, into our theory, right? Because it's completely not obvious, like, what that connection is at this point. And the last thing I want to emphasize is, we saw, the first paper this morning was about, belief formation, right? Like, this is usually what we're sort of thinking about with surveys. This is not what we're doing. We're actually giving people, right, the parameters that they might be using, right? We're not asking to form their own beliefs. We're like, hey, here's the correlation, here's the mean, here's the volatility, right? Do what you want with that information, right? Our results aren't being sort of driven by people sort of forming the wrong beliefs, because we're actually giving that information, and they're responding by saying, look, we really care about the mean, we really care about the risk as captured by the volatility of stock returns. We don't give a shit at all about the risk that's captured by the correlation with consumption. Doesn't matter how you phrase it, our response is going to be precisely zero. Right? And so we think these are both really interesting questions, but they're sort of getting at a very different topic. And so going forward, I think I got, what, 2 minutes coming? 1 minute? All right, cool. I'll be faster. Right? So we're going to see more, this is a seminar we're going to see a bunch going forward, right? This isn't, we're not trying to say that, risk factors don't matter at all, right? What we are trying to do is change the standard of evidence that everyone in the audience asks for, right? One thing that we absolutely need to see if X is a price risk factor, right, is that the relationship between correlations, right, and expected returns is there and big. Totally needs to be there, right? That's one part of this. The other part, though, is that there should be evidence, right, that people are actually following the logic, right, that generates this relationship. Right? People actually have to be trying to insure themselves against the bad shocks that are captured by X. You should be able to, find evidence, like you open up the Financial Times, the Bloomberg, Wall, and sometimes you can, right? Go and look at oil markets. It's obvious that this is where, where these prices come from, right? And once you do that, you should be able to go and elicit this response in the lab, right? If it's really the case that prices are moving because lots of people are looking ahead and trying to insure against something, then it shouldn't be that hard to go and find one of them. Right? And our goal here is to sort of give a framework for doing this going forward, right? And these are the sorts of questions we want to see asked, like in these sorts of seminars and conferences going forward. But cool, that's what I got, and we're really looking forward to everyone's questions.